first session, here is the topic. Up, down and up. What is going on in spec land and what are the opportunities? Although specs have been around for a while, it was in the last 2 years where the world saw a massive boom, globally and regionally. That aid, what happens next in the market, doesn't get highlighted as often. Would the spec bubble reach a saturation point or are we already there? By the way, there is a poll where we'd love for you to interact with. So just head over. There's a poll tab there. Click on it and give us your thoughts. So today you can hear from our panelists as they share their insights on the market's latest trends and where do we go from here. The speakers are Jeffrey Chi, Vice Chairman of Vickers Venture Partners, Kit Wong, CFO, Catcha Investment Corp of Catcha Group, James Graf, CEO of Graf Acquisition Corp 4, Adrian Au, Director of Cantor Fitzgerald, and the moderator is Olivia Poe, the journalist for the Business Times. Okay, everybody, I hope you have a fantastic conversation and everyone enjoy.
Thank you, Lenora, for the kind introduction. Hi, everyone. Welcome to the SPAC panel. My name is Olivia Poe, and I'm a tech reporter at the Business Times, covering startups and venture capital. Now, we have heard about the importance of assembling the right team when listing a blank check company. So likewise, in this panel, we'll talk with a great collection of experienced sponsors and advisors, each of whom has charted their own way into the SPAC world. We'll hear from all of them regarding the landscape now, some challenges along the way, and how they're navigating it. Joining me today, we have James Graf, Kit Wong, Adrian Au, and Jeffrey Chi. Okay, James is the CEO of Graf Acquisition Corp 4 and the independent director of Catcha Investment Corp. He's one of the pioneers of the SPAC trend. He's raised 6 SPACs, totaling $1.8 billion. One of the companies he took public includes sensor technology company Bellodine LiDAR. Kit is the CFO and director of Catcha Group, internet-focused investment company in Southeast Asia held by Patrick Grove. Kit here brings more than 13 years of corporate finance experience from his time at Goldman Sachs, where he was an executive director in the IB division, focusing on TMT companies in Asia Pacific. Now, Catcha has taken 5 companies from startup to IPO and has a SPAC listed in the US. We also have Adrian. Adrian is the director at Cantor Fitzgerald's IB team in Hong Kong, bringing over 12 years of experience in global M&As. He also leads the Asia Pacific SPAC coverage for Cantor, which is one of the leading advisors in the SPAC market. Last but not least, we have Dr. Jeffrey Chi. Jeff is the co-founder and managing director of one of the top VC funds globally, deep tech-focused Vickers Venture Partners, as well as the vice chairman of Vickers Capital Group. His SPAC, Vickers Vantage One, raised over $120 million in the January IPO. Welcome, guys, and thank you for joining this panel. All right, let's dive in. So it's been really exciting, tracking all the developments in the SPAC market over the past year or so. And well, SPACs have been around since the 1990s, but only recently that we see this huge boom, and it probably started, kind of gaining a lot of attention when Virgin Galactic went public. Things have changed now. We're kind of 2 years in. And so for my first question, James, let's start with you. Where are we in the SPAC market right now? What's going on in SPAC land? People like to say that there's this SPAC bubble and it's about to burst. Is there one?
I don't think there's a bubble at all. I wish I knew where we were going, but it certainly is different over the past year or so. Give you some perspective. I've been doing SPACs for over 10 years now, full time. For the first 8 years or so, until 2 years ago, until Virgin Galactic, there was only a small handful of SPACs from 2010 to 2014. When I first got involved, there was only 10 or 11 a year. And then there was 40 or 50 a year. So it was a very small market. And SPACs mostly focused on well-established companies that had a lot of EBITDA, that had a cash flow, that were real businesses. Virgin Galactic completely changed the SPAC world. There's before Virgin and after Virgin. Before then, you had no retail and you had essentially no projections. You had stable companies. Virgin Galactic was the first that was a zero revenue company, had a real hockey stick. They were using the Spac to raise capital for some future business. It was a very big idea that got retail investors very excited. And after the success of Virgin Galactic, which took a while, then you had DraftKings and Nikola that also were early stage or earlier stage, attracted a lot of retail investors, and then the floodgates were open. You had hundreds of companies trying to go public through SPACs. Many of them were too early. But what happened during the last year was retail investors got excited about these ideas. There's a lot of meme stocks, share price got crazy. Then these companies who weren't ready to be public companies missed their earnings quarter after quarter. Share price fell, retail fled the market. And when retail left the market, you no longer had these huge share price pops after announcing a transaction. So typically in SPACs, you get early commitments from investors at $10 a share. If retail investors are pushing the price to $20 or $30, everybody wants to play the pipes. It was easy to get deals done. But when retail fled the market, when you stopped seeing those big pops after announcement, it became much harder to raise the pipes. And that's where we are now. Now, in terms of a bubble, I know I've been talking for a long time, but just one more point. I say it's the best of times and worst of times. You are still seeing, I think there's been this year an average of 3.4 million deals that close every week. You're still seeing good deals that close and trade well. The problem is 90% of the deals close and don't trade so well. But if you, other than the last year, other than this kind of crazy period, you're seeing more deals that close and more deals that trade well than any other time in history. So that's why I say it's so the best of times and worst of times. The problem with the SPAC market, in my view, is not the SPAC market itself. It's the fact that most of these companies shouldn't be public companies today.
Thank you for that, James. I love that you mentioned it's the best of times and worst of times, and it's difficult right now to raise the pipe. Landscape presents a tough set of challenges for sponsors. Maybe Kit, you can weigh in a bit here. How are you navigating this? And do you think the SPAC bubble has kind of deflated a little, maybe?
Well, I fully agree with what James said over there. I'm not sure it's sort of right to call it a SPAC bubble, because to be honest, if you buy a SPAC, sorry, I'm winding back a little bit from your question, I'll get to it. But if you sort of look at the way the structure is structured, right? You have a guaranteed redemption feature. That means that if you're a SPAC investor in it, you don't lose money. You'll just take your money back if you don't like the deal. And so you have the option of coming to the deal, assessing the deal, and therefore sort of, to James' point around, look, that you get a chance to see what that deal is and decide whether it's a good company that you like it or not to hold it long term, or you take your money back. And so I think from that perspective, it's very hard to say there's a bubble, because you're essentially protected, at least for the IPO to business combination part of it. Now, I think the second part of it, which I think your question is around, is it harder to raise a pipe right now? I do think so. And I think that, look, ultimately, the ease of, this is the way capital markets works, is that, look, if it's a great company and a great valuation, it will be, that there will be investors for it. That's the way the capital markets work. So putting aside, the sort of quality of companies, that is an obvious point. I think one of the other things to raise here is also that, look, if you look at the technicalities of it, it's been super busy in the market. There are like almost 400 SPACs that launched this year. And so what it means is that all the market participants have been really busy. So auditors have been really busy, lawyers have been really busy, SEC has been really busy. And so the SEC review process has been extended. And so instead of sort of getting a SEC review done in sort of 3 months or so, it's now taking 4, 5, 6 months, depending on issues. If you have audit issues to work through, legal issues that you weren't ready to go public and you sort of, go through it, that period be extended. And so what happened was that in some earlier deals, PIPE investors committed early and they're locked in an illiquid period for a much longer time than they expected to. So when you're locked in for too long, when you're finally ready to go, you are probably, past your time and you're forced to sell. And when you're forced to sell because you need your money back, then you obviously will be selling at a low price. And when everyone's sort of forced to sell, then the price sinks even lower. And when new investors see PIPE investors in some of the early deals locked in for so long, not making money at the end, then clearly that's a little bit of a unfortunate cycle. So I think this is a technical difficulty that is on top of the quality of company valuation fundamental question that we spoke about. And I think that fortunately, I think the intensity of the deal flow and PIPE flow has calmed down a bit. So I think from that end, we will probably see some of this technical difficulties sort of getting better. And so as people get busy, things get faster, the liquidity gets better, shorter. I do think that that is sort of where we kind of are right now.
Right. I mean, you make a good point, and thanks for explaining all the details. But I think this also brings us back to the fundamentals, like what James mentioned earlier. The quality of spec-ready companies, right? And so just a bit of background for our audience, it seems like actually almost everyone has a spec these days. There are over 500 specs issued this year. That's probably way too many chasing a limited pool of quality companies. We are also seeing quite high redemption rates on some transactions, like investors don't want to participate in a deal and choose to redeem the $10 spec. Regulation is tightening, PIPE investors are more discerning. We are also seeing not so great performance for some companies after the merger. Looking at this from the outside, it looks like it's signaling kind of a fall from favor. And Adrian, I'd like you to chime in for this. How are investment banks reacting to this? Is it a good time for sponsors to go in?
Yeah, so I think from a banking perspective, I think we're seeing this as a good trend, just in terms of eliminating some of the not qualified sponsors, I would say, because like you said, there's been 500, there is a lot. I don't know what's the right number to be in the market and how many quality targets there are, but ultimately, from a banker perspective, we are really only taking repeat issuers, people that have a track record, that can demonstrate that as a spec sponsor, they are able to identify quality targets, value them at the right valuation. A lot of it, ultimately, it's a public company once it's listed, right? And so finding the right target, but overvaluing it on day one also doesn't make sense if the stock price goes down significantly afterwards. So I think overall, what's been happening in the market has been a good thing. Like James and Kit mentioned, it was very strong in the first quarter with a lot of specs IPO, and then April to September, we had a big lull. And then we're seeing the market pick up again. And I think that's a recentering of the business in terms of what are the quality sponsors that really can succeed in the current environment, and eliminate some of the ones that are just followers, but perhaps are not focused enough to be good spec sponsors.
Just make a quick comment on that. I think some of the thinning of the herd is going to happen naturally. If you look at the fact that there's 500 SPACs looking for deals, another 100 that have announced deals but haven't completed, and about 250 in registration. There's probably another 300 or 400 that have filed confidentially. So if you assume 3 SPAC deals close a week, which is much higher than the historical average, but if you assume optimistically that 3 SPACs close a week, that's 150 deals a year. So, you've got 850 SPACs in the pipeline, 100 announced. So if you take away most of those, that implies that maybe 500 SPACs that are either announced looking for deals or filed will fail, will liquidate. It's just math. In my view, the market can't support more than 150 SPACs a year.
Well, that's scary for sponsors. I mean, going in knowing that there's actually a huge possibility that this might fail. So, I mean, just to summarize, sponsors that are more experienced, have done a spec prop before, will probably have an advantage. Jeff, there are some reports of Vickers possibly considering a few more specs in the pipeline. Has that changed now? What is your strategy to navigate this?
I think so. So first of all, our aspirations about sponsoring a SPAC in the first place is kind of tied to the ability to leverage the existing deal flow that we had. So a lot of the earlier panelists have spoken about whether or not there are enough deals on the market and all that. But being a firm that sees roughly 10,000 deals a year, many of which are appropriate and late enough in their process and their evolution to be considered to go public. Excuse me. We saw a huge opportunity to leverage that deal flow pipeline in forms of a SPAC. So that's kind of why we did that. That has not changed. I think in this whole adjustment period, let's call it that, is a flight towards quality. Not just in terms of the credentials of the sponsors, but also in the deals that we do. And then if you do see quality deals being done, then what essentially is going to happen over time is that the SPAC industry will continue to thrive, right? So I kind of personally see that the industry is heading towards a period of consolidation, whereas as James was pointing out the math, I think we're going to start seeing the number of sponsors reduce because it's becoming harder and harder to get a transaction done. But for those who have the sort of elements that make for a successful SPAC, I think they will continue to participate in the industry, and obviously those with more experience have that. So I think the product, if you may, is a very innovative one. It has evolved over the last few decades, and in its current form, I think is actually addresses the risks to all the stakeholders in the industry. That includes the sponsors, that includes the IPO investors, that includes the target company. So it is one that changes the status quo for traditional IPOs. But again, too much of a good thing isn't necessarily great. So I think we're going to see a little bit of adjustment, but I'm bullish in the long term.
Let me just chime in on the back of that. Yeah, sorry, Olivia. I think that one of the to build on that point that you made, I think that SPAC itself is an innovative product. I mean, it's sort of developed over the years thanks to pioneers like Jim. But I think that we also see more and more creative structures when it comes to SPAC. So, for example, just yesterday I saw this deal called Panera Brands, where the SPAC became a cornerstone investor in a straight IPO. So they're taking the money in there and putting in the money as an investor, anchor investor into the IPO, and as a sort of backstop redemption that supports the size of that cornerstone investment. So I think, sort of like, whoa, that's pretty interesting, right? And then you see like, I think certain deals like Pershing Square obviously tries to innovate many things. So, but without going into the details, I think that SPAC itself is a very innovative product, and people are coming with more and more innovative ideas how to best utilize that capital in a way that could make money for make sense for the company as well as investors. So I think we're very excited about that innovation that's on the horizon.
Yeah, thanks, Kit, for pointing that out. I mean, innovation, quality over quantity, right? Okay, so let's switch gears a little bit. We're going to talk about SPAC listings closer to home. So Hong Kong, Singapore have proposed spec listing frameworks, hoping to get in on the action. Although interest in the US has waned a little, but we know US markets are by far the most liquid, and often targets might want to be listed on the NASDAQ or the New York Stock Exchange. I think it has been reported that Catcha and Vickers are eyeing a spec on the SGX. So Kit, I got to ask, yes, no, what is the receptivity like for global spec sponsors towards listings in Asia? How are they approaching it, and how do you see this kind of tying into the landscape in US?
Well, to your question on Catcha and SGX SPAC, I am afraid that I cannot comment, because even if I filed, I'm under publicity rules, so I can't comment. If I didn't file, yeah, you get my point. I think that yeah. So I think on the local SPACs, I think besides sort of Singapore, Hong Kong, I think we also saw a few days ago that Abu Dhabi is announcing a SPAC regime. So I guess going to the point around like, look, SPACs are being here for the long term and being here to stay and becoming a standard tool in the corporate finance toolkit. I think that kind of supports that view there. But as it comes to its Singapore and Hong Kong listing, I think the main question here is like, look, what are the differences here between the two? And the most obvious one would be the fact that, look, in a Singapore SPAC, when you get listed in Singapore. When you get Hong Kong, you get listed in Hong Kong. And when I was a banker back then, one of the very first questions that an IPO bound company was looking for is like, look, what is the right venue? So I think that fundamentally, look, it's a different venue with different considerations around it. And so I think that's one thing that different venues would make sense for different companies. So I think that's one. The second thing is that, look, I think the overall capital market right now is it's a global market. So US investors invest in Singapore, Singapore investors invest in US. And so to some extent, there will be a little bit of, what's happening in the US will trickle down to Singapore. There will be more local investors looking for local companies who will come in here. But I think like that same points around like quality, people focusing on, sponsors who are of high quality and can make money. I think all that will still hold true.
Yeah, and I mean, Adrian, you take care of this APAC spec team for Cantor. Are sponsors sharing the same concerns like Kit? What are some possible things that have come out?
Yeah, no, we're certainly very closely following it. I think both Singapore is a little bit more advanced than Hong Kong. I think Hong Kong is still doing their research. I think it's definitely an opportunity that we want to explore as a firm. I think we've explored other markets in Europe previously, and now building out a team for Singapore and Hong Kong to explore the product. But like Kit said, I think it's really going to be, US is still going to be the main driver. I mean, it's the place that started this. I think most companies will still probably look to the US, but there are going to be a select few where they feel having the local market. I think yesterday in the discussion we had, I think James mentioned, getting equity research coverage, getting people that know the space on the ground, you get much better coverage. And so for an Asian company, it might make sense to list, and ultimately what people decide to do on the spec space will depend on how the actual spec regime for a certain market compares to the IPO regime. And that's still to be seen in some of these early discussions for some of these markets. So it's something that we're following closely.
I'll comment on that a little bit. I actually commented on Singapore's first draft of the SPAC rules back in, I think it was 2008. So it's taken a long time for them to get there. I think there are there's a real challenge and a real opportunity with the Singapore or Hong Kong SPAC regime. The challenge is in education. With the 700 or 800 SPACs that have listed over the last several years, there's very few Asian investors. We've always tried to market in Asia. Catcha market in Asia. I'm sure Vickers market in Asia, but there's a very tiny Asian investor base for U.S. SPACs. It's been almost impossible to get Asian investors unless they're closely affiliated with the with the sponsors. So I think it is going to be an education process, both for Asian investors to understand what the hell a SPAC is, and for the traditional SPAC investors to understand the regimes in these other markets. I think the real opportunity for the Singapore, the Hong Kong listings is you're much closer to the natural investor base. As Adrian mentioned, it's almost impossible to get, bulge bracket firm research for a Asian stock if there isn't a direct comp in the US. So if there's a company that's got an international business and you've got Goldman and Morgan Stanley and Cantor and everybody writing research on it, then it's okay. But to get an analyst to learn about Thailand or Malaysia or Korea just for one stock is very difficult. And it's also difficult to get the local analysts to write about a US stock. And it's difficult to get the portfolio managers to learn about a new market just for one stock. So I think having a listing closer to the investors and the analysts is a tremendous advantage, but it will take an education process to get there.
Right. You made a good point, and actually it ties into our audience question here. We're a bit tight on time, so maybe we can take a quick stab at this. From an investor's point of view, what are the top risks that companies should consider if they choose to go to the SPAC route? James, you touched on having analysts, having a whole support system. Jeff, you have anything you want to weigh in on?
Sorry, was the question from an investor's perspective?
Yeah. From an investor's point of view, what are the top risks that companies should consider if they want to SPAC?
Sure. So first of all, for target companies, right? It's an issue. Obviously, getting involved with a business combination with a SPAC is a shorter process than a traditional IPO. So indeed, there's less risk, but there's also resources nonetheless, right? So I think the key thing to watch out for is really the quality of the sponsor that you're working with, and make an assessment as to the likelihood of the business combination being done. And that, if it involves a PIPE, would involve the ability to raise a PIPE. That if there are other factors in consideration, perhaps reputation of the sponsor and all that. So I think that's the first one. And then from a pure investor's perspective, investing in a SPAC, as Kit had mentioned right at the beginning, it's an interesting product that represents relatively little risk in the period between IPO and business combination. So I think where one needs to start looking more closely at the deal, because funds are protected in a trust that is earning interest, and that's kind of why. But if it's trading significantly above the $10 per share that it started with, then the trust is only $10 a share, right? So if things tend to go the wrong way, then the $10 is protected, but anything in excess of $10 is not. And so the closer you get to business combination, the share price is going to be a little bit more volatile, and so watching out for that, I think, is important. Coming back to that question on SGX and Hong Kong, as Adrian pointed out, Singapore is indeed a little faster, and I'm quite close to the evolution leading up to the announcement of the SPAC regime, and I'm actually quite very impressed with the speed this has taken. I think James pointed out that yes, there's been talk about this since as early as 2008, and we've been looking at SPACs since 2005, and have chosen not to. And it boils down a little bit to how much risk there is to the sponsor for us to get involved. And I think SGX has kind of taken in comments, since their consultation paper I think was in April. They've moved quite quickly. I think there was a real motivation to get something out early this year. And so if you think about what's happened in the last 10, 11 months, it's actually quite phenomenal, I think. And the other thing in Singapore, which I'm quite excited about, is it's not just the SPAC regime that they're thinking about. They're thinking through the whole thing as to how to create investor interest and how to bring capital into late stage investing for Singapore and for Southeast Asia. So I'm actually quite excited, and it'd be interesting to watch. I think the next 6 months as the first batch of SPACs begin to get introduced to the market. There are things I think that still need to be ironed out, but that's all just work in process. I guess the last thing I could say about sort of Asian SPACs or SPACs outside the US is that everyone saw the numbers in 2020 and in 2021, right? In 2020, there were more than half of all IPOs in the US were SPACs. I think the year-to-date numbers I checked a few weeks ago was clearly more than 70% of all IPOs are SPAC related. Any local exchange would look at those numbers and say, why aren't we doing this, right? So I think it's for the growth in the exchange, everyone's thinking about doing this. But at the end of the day, the SPAC model, in a way, takes some of the judgment in the process out of the hands of the regulators into the hands of the SPAC sponsor. And I think regulators that believe they have something that allows them to be able to supervise or to be able to have oversight over the sponsors, as opposed to the deal itself, will feel more comfortable in going ahead. And that's kind of where, if you look at where the SGX consultation paper came out and where it ended up, and the Hong Kong consultation paper came out and is still under review, they all start with the point that let's not let go of anything yet until we hear back from the market. So it'll be interesting to see how this plays out. A lot of people say the Hong Kong rules are not attractive at all, but the same could have been said for Singapore 6 months ago.
No, that's right. I want to expand a little bit on something you mentioned about looking at the risk, right, for sponsors when deciding whether to spec on a listing on a bourse. How much risk is there for sponsors in Singapore, Hong Kong compared to the US? Much more risks?
Let me start, and I think James probably has a lot more to mention. But in my personal view, right? So the thing about risks in the US is primarily about risks in getting the transaction done, because of the product is very well known, and there is an affectionate term in the industry called the SPAC mafia that will basically pick up SPAC IPOs. So it's as Kit mentioned, it's a relatively risk-free product that has a following, and people will buy it. I think in Singapore it's less, or in Asia it's less so, right? The market, as James was pointing out, needs to be educated. So there is more risk in terms of the IPO, and if you look at the rules in general, right? Some of the earlier, and even in the US, the earlier model that SPACs had gave a lot more leverage of the SPAC investors over the sponsors. So that represented quite a bit of risk to the sponsors for getting in, and because of that evolution that allowed more equal play, sponsors started feeling more comfortable that the investors couldn't effectively reject the deal for the sake of rejecting the deal. So I think that kind of, but I'd love to hear what James has to say, because he's been in this game a lot longer than I have.
I think you said it exactly right. The risk is, the risk for sponsors relate to being able to close a business combination and hold on to as much of the sponsor economics as you can. So, if you look at an environment where half the sponsors are going to liquidate. The U.S. isn't that safe either. So I guess it comes down to, in which market you have the highest amount of confidence, you can close a business combination, which means you're going to be able to find investors to hold on the back end. You're going to be able to migrate shares, and I could argue either side of this story, but I think you're more likely going to find more after the closing of a business combination. There's a question of whether Asian investors will play the back end of a deal before closing. But once you close and you're a regular public company, I think you're going to see much more liquidity for an Asian company trading on an Asian bourse.
Right. Yeah, that's a good point.
You look at things like, there was a case with, what was the company's name? Ribbons. It was an e-commerce company from Singapore that went public in a SPAC, and it was a good company, but it got no following in the U.S.
Yeah. We're probably running out of time, so just this concludes the panel. Specs for the long run, right? Thank you so much for joining. Thanks, Jeff, Kit, Adrian, and James for sharing. And I think, Kit, you have another panel later on, right? So for our audience, stay tuned for that. It's about the route to US public markets for Southeast Asia companies. So also pretty relevant to this panel. Very interesting one. I'll be catching that. Have a good day. Enjoy the rest of the Wild Digital Southeast Asia Conference. Bye.
Thanks, everyone.